Good morning. We will pay attention to closing transfers today. We have the sales account that is a nominal account, and all nominal accounts are closed off at the end of the year and transferred to the trading profit and loss account. So we don't want any balances in our nominal accounts at the end of the year. Because sales is an income that have a credit balance, we will have to debit the sales account with the 84,000 so that we can close off this account, and because we debited sales, we will credit the trading account with 84,000. And we will indicate in the trading account that this amount will be transferred from the sales account, so the double entry is in the sales account and the amount in the sales account is on the credit side of the trading account. The cost of sales is an expense that will have a debit balance of 48,000. To close this account, we will credit the cost of sales account with 48,000 and we will debit the trading account with 48,000. We will use the word cost of sales to indicate that this double entry was completed in the cost of sales account. The whole purpose of the trading account is to work out what is the gross profit. That is the difference between the sales price and the cost price. So the total on the credit side is 84,000. Then the total on the debit side must also be 84,000, and we will work out the balancing figure subtracting the debit side from the credit side, and that will give us a total of 36,000. And that 36,000 will be transferred to the profit and loss account. In the profit and loss account on the credit side, I will indicate that we transferred 36,000 from the trading account. We have a commission income account with a credit balance of 16,000. So we will close this commission account, debiting the commission account with 16,000, indicating that the profit and loss account will be credited with the 16,000. So all my income and expenses are closed off to the profit and loss account. The salaries account have a debit balance of 14,000, so we will credit the salaries account with 14,000 to close the account. Other expenses have a debit balance of 8,000, so we will credit the other expenses account, indicating that the amounts in the expenses account will be debited to the profit and loss account to close off the accounts. So salaries is 14,000, the other expenses 8,000, and if I add up the credit side, I will get 52,000 on the credit side. That means the total on the debit side must also be 52,000, and then I will subtract the amounts on the debit side, giving me the balancing figure as 30,000. That means that we made a net profit after all expenses and income were taken into account, and this net profit will be transferred to the capital account on the credit side because the owner provided the capital for the business to make a profit, and the owner is entitled to this profit. If we look at the credit side, we see that the equity of the owner after the profit was added is 60,000. But the owner already took 31,000 from the business during the year, So we have to close off this 31,000 to the capital account to determine what is the actual equity at the end of the year after we've taken the profit and the drawings into account. So therefore, this balance will be 29,000, and we will bring down a balance of 29,000. We take the drawings to the capital account to indicate that the owner already benefited from the profits that were made in the business because he took money or goods for his own use.